Hey everyone, welcome back to Corporate Decoder. Today, Duke just filed an 8K about issuing new bonds, and I am seeing a key detail that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing is all about Duke Energy Carolinas raising a lot of money through new debt, and we'll break down what that means for the company. So, we're looking at a current report from Duke Energy Carolinas LLC. This form, the 8K, is for reporting major events that shareholders should know about. The main event here is that on the 5th of June 2026, Duke Energy Carolinas, or the company as they call it, finished selling a huge amount of bonds. They did this through an agreement with quite a few banks acting as the underwriters. Think of underwriters as the middlemen who help companies sell their debt to investors. Let's break down the money involved. They issued 3 different types of bonds, which is essentially them borrowing money that they promise to pay back later. First, they sold $400 million worth of bonds that mature in 2031 with a 4.65% interest rate. This means they will pay 4.65% interest each year on that $400 million until 2031 when they have to pay back the original $400 million. They issued $1 billion worth of bonds maturing in 2036 with a 5.15% interest rate. That is a massive amount to borrow. And finally, another $1 billion in bonds maturing in 2056 with a higher interest rate of 5.75%. So in total, Duke Energy Carolinas just borrowed $2.4 billion. This is a significant amount of debt. These bonds are backed by what's called their first and refunding mortgage, which has been around since 1927. That is incredibly old. They've had to update it many times, and the latest update, the 113th supplemental indenture, was done specifically for these new bonds. The Bank of New York Mellon Trust Company is acting as the trustee, which means they represent the bondholders and make sure the company follows the terms of the bond agreement. So, why is Duke Energy Carolinas borrowing so much money? Typically, utility companies like Duke Energy need massive amounts of capital for infrastructure projects. This could include upgrading power grids, investing in renewable energy sources like solar or wind farms, or maintaining existing power plants. Borrowing through bonds is a common way for them to finance these large, long-term investments without diluting existing shareholders too much by issuing more stock. The fact that they are issuing bonds with varying maturity dates and interest rates suggests they are managing their debt portfolio. The longer-term bonds, like the ones due in 2056, offer a higher interest rate, which investors might prefer for the longer payoff period. This section lists the exhibits filed with the report. Exhibit 4.1 is the actual indenture, the legal document that lays out all the terms and conditions for these new bonds. It also includes the forms of the global bonds themselves, which are like the digital certificates representing the debt. Then there is Exhibit 5.1, which is a legal opinion about the validity of these bonds. This is standard practice to assure investors that the bonds have been legally issued and are binding obligations of the company. And Exhibit 99.1 is the underwriting agreement itself. This is the contract between Duke Energy Carolinas and the group of banks, outlining the terms of their agreement to buy and sell these bonds. It includes details like the price they paid for the bonds and how much they will sell them to the public for. The fact that there are so many underwriters listed suggests this was a large, complex offering. Now let's think about what this all means. For Duke Energy Carolinas, this is about securing funding for their future operations and growth. The interest rates on these bonds, especially the higher ones for the longer maturities, reflect current market conditions and the company's perceived risk. A 5.75% interest rate on a 2056 bond is not excessively high for a utility company, but it is something investors should be aware of when considering the company's financial health. A key point here is that this is not equity financing. They are not selling more ownership in the company. They are taking on debt. Too much debt can become a burden, especially if interest rates rise or if the company's revenues decline, making it harder to make those interest payments. However, for stable, regulated utility companies like Duke Energy, debt financing is a very common and generally well-managed strategy. They have predictable revenues because electricity is a necessity. If we were to look at their balance sheet, not in this filing, but in a more detailed financial report like a 10K, we would see how this new debt affects their overall debt to equity ratio, which is a key measure of financial leverage. However, based on this 8K, the story is straightforward. Duke Energy Carolinas is raising a substantial amount of capital through debt to fund its ongoing operations and future investments. Looking at the broader picture, utility companies operate in a regulated environment, meaning their rates are set by government bodies. This provides a degree of stability, but also limits their ability to increase profits rapidly. Their major expenses include fuel, power generation, transmission costs, and of course repaying their debt. The interest expense from these new bonds will be a recurring cost on their income statement in terms of risks. The primary concern for any company taking on significant debt is its ability to service that debt. Any disruption to their revenue streams, unexpected increases in operating costs, or a sharp rise in interest rates beyond what's currently factored into these bonds could pose challenges. However, given Duke Energy's established position and the essential nature of its services, the risk of default is generally considered low, but not zero. In conclusion, this filing is a routine but significant event for Duke Energy Carolinas. They are proactively managing their capital structure to fund their growth and operational needs. The sheer size of the bond issuance, $2.4 billion, highlights the capital-intensive nature of the utility industry. For investors, understanding the cost of this debt, which is reflected in the interest rates, is crucial for evaluating the company's future profitability. This issuance basically locks in borrowing costs for those specific terms, and the company is betting that its future earnings will comfortably cover these expenses. What I am actually looking for is how this debt impacts their future cash flow and their ability to fund upcoming capital expenditures without an over-reliance on even more debt. That is my take. Stay decoded. If you want the broker and charting tools I use day to day, they are in the description. Grab a free sign up if you want to support the work. Like, comment, subscribe, and join our Discord.